We are live, ladies and gents. Good evening to you, good afternoon to you. It's a very pleasant summer. Is it summer yet? I guess it probably just about is. Feels like it, but a few lovely warm days. If you're from the UK, you will agree. It's very nice to have some sunshine on your face for a change. I am glad that you've taken time to come on this webinar. Thank you very much. Appreciate your effort to coming on. I will endeavor to give you as much information as I possibly can. The job of these webinars, and let me introduce myself first. Some of you don't know me. My name is Mark Holstead. I've been trading for 20 plus years, started in 2001. Price action trader, if I had to label myself as something, that would be it. I don't really mold myself as a day trader or swing trader, depends on the current conditions. Happy to do a day trade over a 5-6 minute period. Happy to hold a swing trade for 1 to 3, 4, 5, 7 days, maybe, but that sort of thing. That's the way I like to operate. I have a podcast, Traders Mastermind podcast, free daily email as well. If you want to go to tradersmastermind.com/email, you can have an email every day. The idea of that email is for me to help me get my thoughts out and to think of things that are going to help you improve your trading during the trading day, or something to keep in your mind, maybe think differently about something, just to keep you moving forward with the trading. So let's get started. Thank you very much for coming. Let's go. This is going to be really a lot of information. I always seem to do this, right? I come up with these webinar ideas and I think, okay, because the webinars are more structured. So lectures are a rubbish word to use, but it's more structured, right? It's a more structured topic and theme to it, and I kind of go deep into it, and I, go into the sort of angles that I want to the information I want to give you, and be as concise as possible, but I end up like adding so much stuff in, and sometimes I put too many slides and look at these slides thinking that's a lot of slides, it's a lot of information. But really the objective of these is for you to see the webinar and take a few bits from it. I know that that's really the way to work with trading, is to just listen to some stuff and take away a few bits that are going to help you improve your trading. You don't have to agree with everything. You find the bits that work for you and develop your trading business and your trading approach. All right, so let's get started. How we normally operate with these is I will run for about 45 minutes, and then we'll have time for some Q&A at the end. So if you've got any questions, anything you don't understand, then please, feel free to ask it in the question section. I will do my very best to answer it. Obviously, if it's about this topic, I'll be able to answer it. If it's about something else to do with trading, I'll most of the time be able to answer it. But if I can't, I will direct you to someone or somewhere that will give you a better answer. I know that even though I've been trading for a long period of time, I don't have all the answers. I don't claim to have all the answers, but I've got some knowledge and some experience and success. So let's get going. Okay, so risk disclaimer, guys. Spread bets, CFDs, complex instruments, all this kind of stuff. You must be very, very careful before you get involved with trading on leveraged instruments. Let me just double check my audio is good. I think it is. Someone will shout out in a minute, I guess, if we don't have any audio. So let's get going, guys. Okay. So this is the second part of a 2-part series called Mind the Gap. And I know that many of you perhaps don't trade instruments that gap too much, but I do feel that having a broad understanding of what's moving markets, even if you don't specifically trade equities or indices, maybe a forex trader, just understanding how money moves around helps. And also I'm a big fan, I'm a big believer. I've been through periods where stuff's worked really, really well, and then it just stops working, and you go, oh, now what do I do? That strategy was quite effective, now it's not. What do I do? So I'm always a big advocate, and I always recommend this to other traders, is to be aware of other strategies, be kind of building different strategy playbooks. And actually something that we're coming up with the next month or two, I'm going to really go into some depth about that, building that playbook up and developing the strategies and developing something that's robust and can withstand different conditions. So whilst this might not be something that you want to do now, maybe you don't trade it, maybe you do. If you do, that's great, but this is something that's, I think, is valuable to kind of understand. All right, so second part here is Mind the Gap. And I like to put a little quote in here, and this is: the desire for constant action, irrespective of underlying conditions, is responsible for many losses in Wall Street, even among the professionals. And those of you who are very astute and very observant will know that that was included in the last webinar. Why? because this is such an important quote. Jesse Livermore, go and read Reminiscences of a Stock Operator. If you haven't, it's an absolute classic, recommended to every trader. I've given away dozens of copies to traders. It's a storybook, but there's so many lessons in it. It's about a trader who was trading in 1930s, 2030s, that sort of era. And, so many lessons from that were just little nuggets, little sentences, little comments that we just take through to the modern markets. And that's a great one. This over trading, this constantly wanting to be involved with the markets, whether it's for a dopamine hit, whether it's because you've got one foot in the gambling, over the gambling line. And this, you've got to be careful, right? We enjoy trading, and you've got to be careful that it doesn't become something you enjoy the click of the button. We should enjoy the process, enjoy going through the strategy, do the checklist, all that stuff. The whole thing should be enjoyable rather than just being involved with the market, because this over trading just doesn't do it any good. Anyway, going off track, let's stick on track. Let's stay focused. Mind the gap. Part one, we talked about momentum. We had gap identification, and we had the gap and go trading strategy and some of the triggers from that. Recording will be sent to you if you've already registered for that. If you haven't, I'm pretty sure there'll be a copy sent out as well. But just email Pepperstone, they'll sort you out the copy if you're interested in that, if it's the first sort of webinar you're jumping onto. All right, part two, we're talking about this today, which is fading. So today I want to talk about the common gap trading mistakes to avoid. There's a few, and the reasons to avoid, and I generally have them sort of in my mind or note them down, say, hey, just be careful of this. I'm going to talk about the gap fill fake strategy, how to screen for gaps. The V-shaped reversal setup was what I was going to cover, but actually I went into so much depth about all these other bits that I'm going to apologize to you now and say this will come at a later date. It's a very important setup, and I didn't want to gloss over it and just skim over it. I wanted to go into some detail, so I'm going to bring that back at a later date. That's why I put an asterisk there. I know I mentioned that would be coming, but I'd rather give you more information in depth and some quality stuff about everything we've got here, rather than trying to cram too much in. Adding to winners, some sort of examples of that, and then as I really like to. Those of you who know me know that I like to, I'm a discretionary trader. Absolutely, I'm a discretionary trader, but I do like to leverage on technology to try to help me build systems, build strategies that I can deploy myself, or give me some sort of data that would suggest, hey, you know what, you're right in thinking there's a turnaround Tuesday. You're right in thinking that there's a power hour on a Friday. You're right in thinking that gaps fill over. These little things that I know and I've observed over time. I'm not a quant by any stretch of imagination, but I know people who are. I know developers, and I build these little tools that help me just understand, how the market, the real data behind the stuff you observe. Because you're a discretionary trader, right? You see something, you go, oh, I've seen that before. And what I like to do is go, okay, how can I build a testing tool? Very rudimentary, like it's on TradingView. We're not talking, very complex here, but just to see whether I'm right. And I shared with you the opening range breakout tool, which is really, really good, really useful tool. That's tradersmastermind.com/ORB if you'd like a copy of that. And now I've done one for the gap, testing out the gap tool. So go into that in a moment. So let's get going into some of the content. So last week we talked about identifying and categorizing the gap type, deciding the price target, select your trigger, wait and observe, reinforce the idea or not. So that's really the playbook in a nutshell. You categorize the gap type, and that's super important. That's super important. I know we went into a lot of depth on that last time. That is important. Runaway gap, exhaustion gap, common gap, making an assessment of what that gap type is. And we'll do some more of that in a moment, but for the gap fill type trade. Decide on the price target. I'm a big believer of going reverse engineering. So are you looking for a gap fill? Are you looking for an extension? What are you looking for? And then reversing back into that. And the final piece of the puzzle is to select a trigger to get in that trade. So if you say, right, example, I think the gap's going to be filled. I've categorized this as a common gap. Common gap is likely to be filled. Ultimate price target for me is going to be the gap fill, prior day's close. What's the trigger? So we can't just dive in. Is the trigger going to be an opening range breakout? Is it going to be a trend line break? Is it going to be a break above a prior low, or below a prior low, should I say? I've got some examples and went through those last week, but some more today. And then the key thing, part of the first quote from Jesse Livermore, wait and observe, and you're constantly reinforcing the idea or not. What I mean by that is we're just constantly looking at price action. We need to be, is this correct? Is my thesis correct? Is my thesis correct? Now, I got to be careful there because there's a fine line between overthinking you might be an overthinker, right? You have a trade and you think, oh, is it long? Is it short? Am I right? Am I wrong? I'm going to lose money, blah, blah. And your mind just goes, and you just don't get anywhere. So we don't want to overdo it, but we still want to be looking at the key aspects. And we'll go into some detail about that in a moment, but really understanding the relationship of price to these key anchor points that we'll talk about. So there's really, it's simple enough, right? And we don't have to overcomplicate things, but there should be a almost mental flow chart of how you make a trading decision. And any trading decision, really, we're talking about gaps obviously this week, but there's any setup or any sort of methodology you may have, just having a simple flow chart, filter and trigger ultimately. That's all it is, guys. You know, and this time we're talking about from a gap perspective. Okay, so there's a lot of mistakes on here. Frequent gap trading mistakes. Not watching the opening print. It is significant, right? We want to see where that open is. There's no point just saying it's a gap. You know, it's important to see where we've opened. We talked about gapping above high, price highs, gapping below lows, the size and magnitude of the gap. If you're trading equities, that's very important. What's the catalyst for the gap? Not watching price response at the open. And what I mean by this, and we'll see some chart examples in a moment, is how price responds. If you're looking for, you know, a gap fill, if it suddenly just rips off and pulls back and then rips off again, that's probably okay. Maybe will fill, but not yet. Just wait. You know, we don't have to force what we want on the markets now. The market doesn't care what we want or we think. So being observant about that price response at the open. Another key thing I think is a mistake is when people don't look at the VWAP. So the VWAP is, you know, it's a really, really key focus point for algos. Don't go into too much depth on this. We've covered this before, but you know, if the price is constantly above VWAP, that's telling you that people are prepared to pay higher than perceived fair value, if you like. It's not actual fair value, that's something, a different terminology, but that's the way I look at it. I'm not having a clear roadmap. Essential. If you ignore everything else, please have a clear roadmap. You will find that the clarity and confidence comes after you have that roadmap of how you're going to execute. Now, the roadmap might be wrong and you might get stopped. All these things might happen. Of course, you're going to manage your risk, but flip-flopping back and forth between, I think it's going to rally, it's going to break away gap. No, it's going to fill, it's going to do this. Flip-flopping is not going to help you. Have the roadmap, commit to the roadmap, and then decide whether to execute or not and where your risk is going to be. Changing back and forth is tricky, and I don't feel that it serves many traders at all. It's better to have that roadmap, and then you go, hey, does price action reinforce this? So ignoring the price action clues is a mistake. If you're so stubborn, it's going to fill, and it's ripping, and it's rallying, it's holding high, tight flags, and it's going again, it's pulling. You just got to go, hang on a second, I might be wrong at the moment. Don't throw the whole thing out the window, but just a step in front of this train doesn't make sense. There's no clear trigger. Fading huge gaps, if you're trading equities, I think fading huge gaps tends to be a mistake. There's a sweet spot somewhere. You don't want a massive gap that's repricing that asset dramatically. You want a gap that's just a little bit of supply-demand imbalance, but likely to fill. Ignoring the fundamentals behind the gap, if there's a catalyst, if there's earnings, if there's economic data, if there's something happened at the weekend, you're trading, trading currency pair, the weekend something's happened in Europe or US or whatever currency you're trading, is that going to fundamentally affect how people perceive the asset you're trading? That's key. Thinking in terms of how our institutions thinking about this is important. And flip-flopping back and forth, cover that one. Ignoring the daily trend. So key. I know that many traders go, and it's funny actually, interestingly, on Traders Mastermind, part of the thing we do is we have our weekly calls, or we have chat with each other and we talk about trade ideas and how to, what we're doing, what's working, what's not working, and kind of going around. And one of the things that's coming up frequently with the traders is, hey, you know what, I'm really paying much more attention to the daily. It's the daily, even though I'm a day trader and focus on the short term, scalping almost, or 5 minute, 15 hourly kind of moves, understanding the daily chart is really keeping me out of trouble, stopping me getting caught up in chop and aligning myself with the right conditions. So even if you forget that and just think of gap trading, I think it's a mistake to ignore the daily trend. You may be a day trader, you may just want to execute and take what you can out of the markets from a short-term perspective, but actually, understanding the tide, the rising tide lifts all ships, that old phrase. And it's true, like a strong daily, if you've got a strong daily chart and a gap is low, it's likely to be filled, right? Strong, gaps lower, unless it's some sort of fundamental change, of course. then it's likely to come back up because people are buying that for whatever reason. That's a strong daily means. A weak daily, gap's lower, it's probably not likely to be filled. So just really recognizing how the daily fits into that playbook. Okay, so let's talk about the gap fill versus gap fill fake. My terminology could improve. I know some people out there who call these setups really cool names like Pinball Wizard and Volcano and Super Rocket Double Flip Whip. I try sometimes to do that. I'll do better because I know that helps people memorize things, but fancy names doesn't necessarily mean it's a better strategy. But I'll do better. I think I'll probably come up with something better. Anyway, gap fill, standard gap fill, I think you know what that means. Gap fill fake. So we'll talk about the gap fill fake in a moment, but you've got two choices really. Are we looking at the gap to fill? And by the way, this is not, if we've categorized it from, it's not a runaway gap, it's not an extension gap, it's not any of these kind of real breakaway gaps. It's not these real kind of strong moves. This is like, hang on a second, this gap we think it's going to fill. Now, what we've got to be careful of is a fill fake is where it starts to fill, stalls a bit, and then rips off. That's the nemesis of a gap fill trader because we're looking for the fill. It's a mean reversion type trade in a way. So we've got to be mindful of that. So we can either position for that or we can position for the gap fill. All become clear in a moment, I promise. They often start the same way. Something changes. And again, going back to the prior slide, the daily chart is so important because that's going to give us a clue. If a gap is gapping up and we're in a downtrend, then that, unless something major has happened, that's probably going to fill. It's probably going to fill because the weight and pressure of that supply coming in over the daily chart, unless something fundamental's changed, the trend will likely continue. So, we want to categorize the gap. The common gap is against the strong trend. It's got fill potential. Breakaway gap is with the strong trend. That's a fill fake. So if we are uptrending, gaps up, starts to come down, looks like it's going to fill. Everyone gets sucked into trading the gap fill, finds some support, rips off. We've got to be careful of that. So I'm going to talk you through ways that we can identify and clues we can get from the market and pre-market to try and position the best we can, because we never know 100%. Of course we don't, right? But what we can do is gather, and what I like to do is this, and I think people find value from this as well, and hopefully you will, is that we're really trying to just build clues, take little bits of information, stack it all up and say, hey, you know what? That's now very, very likely, or that's very unlikely, or that's highly likely, and then bet accordingly, trade accordingly. When we have something that's setting up and it ticks all these boxes and we're like, hey, I've seen this movie before, I know how this ends, I'll take the trade, I'll manage my risk. The mistake, of course, is that people go, oh, this is dead cert, anything can happen, it's only a probability game we're playing. But if we build these clues and add the probability and improve it, then eventually we have something we go, yeah, you know what, that's worth taking, that's worth risking X on. I could make 3X if I'm correct. I think this has got a decent chance of success as well. Let's take it and create your plan and stick to it. And like I say, you'll never be 100% correct. And we're not pretending to be 100% correct. We don't need to be. We just have to manage risk so that when we're wrong, it doesn't damage us too much. And we need to make sure that when we're right, we're making as much as we possibly can. We're not coming out too early. We're doing all those other good stuff. There's a phrase that says, I don't know, I'm going to swear on here, but it says, eat like a bird and let's say poop like an elephant. That's a phrase that's banded around in the trading community. You can know what the word actually is, but that's, some traders do that. In other words, they're making profits for a very small amount, and then when they're making losses, it's a big, huge, steaming loss. We don't want that. We want to be the other way around if possible. Okay, so enough of that nonsense. Let's talk a little bit about the gap fill fake first. So as an example, this was wasn't SPY at all. It was Qs, which is NASDAQ the other day, actually not too long ago, had a big gap up, right? And it reversed. It started to come back lower and started to fill the gap. Then it found some support, and then it reversed. Okay, so that's a gap fill fake. Let's explore a little bit more in a second. This is a gap fill. So this is SPY, and the reason I'm using the ETFs is just so you can see the gaps are more meaningful on the indices. I know you can trade those 24/5. You're trading, an index, a European index, a US index. I know that they trade, but if we look at the cash session, then that's really when the bell technically goes and the underlying assets that are creating that index price start to trade. I know there's a futures contract and it can get complicated, but really that's when the biggest volume is done. And so an easy way to do it on trading view is just use SPY for your ETF or just use QQQ for your NASDAQ, and then you can see your gap. Opening range breakout short, gap fill quite quickly. So these are just examples. I'm not just skimming over stuff. That's a gap fill fake, starts to fill, doesn't. We're going to look at clues at how to identify that in a moment. And this is a gap fill. Okay, so now we've got the difference. Let's look at the gap fill. So if we're looking for a gap fill, we're basically fading the gap direction. So gap fill means gap up, looking to go short, gap down, looking to go long. We want to identify that as either an exhaustion gap or a common gap. Now, I want to add this. I didn't add this, but I should have done. Be careful with the exhaustion gaps, because very often exhaustion gaps just sit there and do nothing. They don't often fill. It might, maybe that's just the moment, the last kind of year or so that's happened. But common gaps are better if you're trading for a gap fill. So a small, reasonable gap, nothing crazy, and just a standard run-of-the-mill gap and positioning for the fill. But we've got more to do. Obviously, we're not just going to trade it straight off the bat. Daily chart, crucial. Backdrop, crucial. Why has the gap happened? Is it massive? Is it small? No problem. Let's just put it in context. Look at it. Regular gap, quite likely to fill. And we use the common triggers to enter. So an opening range breakout, that's a really good systematic way of entering the gap fill. So if we have a gap up and we use a 15-minute opening range, we just look for a short on a break of that first 15-minute range. It's a good systematic way of trading the gap fill. Your stop goes above the high. If you want more details on that, say go and check out the webinar I did, opening range breakout. But you can see how we stack these things together, right? We stack together one strategy, one methodology, one setup, one trigger, one filter, and then we build that into a playbook and go, okay, that's got a decent chance of success. We've got to manage the risk. We don't know. That works okay. That's okay. Put them together. Now we've got something that's really valuable. Again, being patient. A candle break, etc. So the gap fill fake strategy, okay, looking at these strategies from a kind of bird's eye view here, is when the price sucks people into thinking the gap's going to fill and then reverses. Just like we saw on the Q, that's why we wait for the second response before committing to direction, and we keep the daily trend in mind. What do I mean by second response? I mean, let's just watch that open for a bit. Don't dive in, no need to rush. Let it mature. Let's just see what the price response is. You've categorized it as a common gap. Nothing crazy, looks all right. Looks like it could fill, sticking to the roadmap. Let's just wait, just see, watch the price. Keep the daily trend in mind. Yeah, everything's lined up. This is like it's going to fill, or it looks like a gap fill fake. Let's just see what the response is. Observe context. Context is something that's very difficult to, it's very difficult to, be very, very binary about. It's one of those things that I think that's why, discretionary traders tend to do better than algorithmic traders. There are a few exceptions, of course. Is a generalization, is that context is something you can take into account and you can kind of mentally put weight on things. That little bit of news there, was that interesting? Oh, the backdrop, we're all worried about this in a macro environment. I think that's more important than this and that. And you kind of understand the daily chart is this, and you put things into perspective and context. And even if you take nothing else away from this, maybe adding a context sort of filter to your strategy and your workflow and your flow chart, your mental flow chart before you pull the trigger on any trade. Perhaps add a little bit in and say, hey, what's the context of this? Where are we? Are we bullish? Are we bearish? Is it fear? Is it greed? Is it nothingness? Nothingness, great word. Just something to add that layer of context and help that develop as well. All right, so here's a gap fill fake, classic example here, Nvidia the other day. Push lower, started to look like it was going to fill, and then it came back up and it started doing business above the VWAP. We're going to look at that in a little bit more detail in a moment, but this is really key. Opening print here, pushes lower, pushes back up. You might be like, well, how do I know? How do I know? You don't, but we build clues. We build clues. And the thing is with Nvidia, at this point in time, the gap up was like 26, 30%. So this is one of those where you go, okay, maybe there's some profit taking, but for a big stock like that, there was a fundamental reason for it. There's a go into this stuff. There's a fundamental reprice of this stock. And so you go, okay, if people are willing to pay that much more of a premium, I'd be careful, man. That's not really a gap to go crazy about fading. There must be some sort of consensus. Let's just see how it responds. Knee-jerk opening move lower, profit taking, to be expected, right? But then the response very, very quickly is that it holds VWAP, and it holds VWAP pretty much all of the day. And that's such a key thing. You know, whether there was a trade in this, I don't think there probably was. I'm pretty sure you wouldn't have got the low here and bought that. There's no way I'd have stepped in front of that. But, you know, this just like, you know what, maybe it's not a gap fill. So even if this was up maybe 1%, below 2%, something like that, you might have gone, you know what, that's just telling me that people are buying this. People perceive this as a buy still. So it's watching that price response at the open that's so key. So some rules to think about for the gap fill fake. The gap lower or higher meeting your criteria. That goes back to week one. I don't want to go over all ground, but that goes back to week one. What's the criteria? And we'll look at how we're going to screen for those in a moment. Initial 10 to 60 minute move towards the gap fill. Price then stalls, and let's just call it a gap to is gapping up. Support then forms. Volume declines. You get a bit of retracement. A key line in the sand is breached, is not defended. Think, is there anyone trapped here? Because that's generally, you know, one of the things as well that happens. A trader's trapped. There's a daily chart forming some sort of trap traders. And I know I'm bringing a lot of concepts in here, and you feel free to ask me this question on these, but I don't want to ignore stuff that I think is valuable just because we haven't perhaps gone into it in depth. What's the narrative of the move? Is there context behind it? Is there fundamental reason behind it? Is profit taking likely first before we get the true move, like Nvidia? And think about playing chess. Think about playing chess. Okay, so let's look at an example here. We gap up, right? And if we go back to here, we can see on the cues the same situation. Where are we? Here we go. Same type of thing, right? We gap up. Put your opening print in. So important. VWAP, if you were on TradingView, use the anchored VWAP tool. That gives you a nice way of anchoring it to the opening print. You can anchor it at the open, change it to an open setting. Right, we start to fill, but then look, it starts to find support and volume starts to decline. So what do we think from this? We start to think, hey, you know what? Maybe this reprice is being accepted. Maybe there's initial profit taking because maybe it would be no one's trapped as such, not like a short float stock that's going to rip off the open. Hey, you know, maybe it's going to it's find some support. Every low gets bought, and then it starts to come back up. The VWAP, good line in the sand. There's a big level of resistance there. Comes back up. That's changed the whole structure of the trade, right? You no longer want to look for the gap fill. Now, if you want to go long there, that's a different trade, of course. You feel like you want to take it to highs. I don't think there's enough meat in it, but you know, at the very least, it's going to stop you looking for the gap fill because you're watching price response. Because at the beginning, it's fine. You're like, okay, 5, 10, okay, good, looks good. But then when it's just stalling, you're like, okay, just wait. Volume's declining. Wait, people aren't selling this. People are accepting this level. There shouldn't be support forming too much, or if there is, it shouldn't be very long. And then when it does another test of the low and starts it, then you just go, no, you know what? You know, my gap fill thesis is no longer valid. Let me move on. Let me think of something else. Okay, so the gap fill strategy, if everything lines up and we expect that common gap, we can position for the gap fill. So if you're just gapping up a small amount, we can position for the gap fill. Pre-market assessment, we're looking at the open type, how it rotates around VWAP, and that's key. And I know it's quite a big concept really to just bring it into this on a couple of slides, but really understanding why the VWAP is so important and why algorithms are using it, why institutions are using it, and why when we have a significant price movement like a gap, why that then becomes so much more important, because so many more people are participating when there's a reprice. Shorts stuck, longs want to get in, people who are long already want to take. There's so many players who are suddenly woken up and going, oh, this thing's gapping up, let me do something. And so the VWAP then becomes far more important. And more importantly to that is the price response at VWAP, or price position above or below VWAP, how long it spends above, how long it spends below. This is something that I haven't seen around. This is something I just observed from having a ridiculous amount of hours of screen time. And just when you see how far price gets away from the VWAP, volume weighted average price, what it does in response to it, especially when the overall context is one of some sort of urgency like this, that's when it becomes interesting. Now, VWAP can become a bit dull and meaningless under sort of choppy conditions. You get rotations around VWAP, but like I say, when everyone's eyes are on this asset, whether they're in the market or they want us to get in the market, this is when things like this become interesting. And when we go, that's useful. That's going to give me clues. That's going to let me look under the bonnet and see the real true supply demand. So watching that VWAP, the response of VWAP, especially during these big gaps, is such a key tool. General feeder price, again, this is the context, and daily chart. Understanding that daily chart is at a small gap lower in an aggressive uptrend. That's probably going to fill. There's a good chance of filling, right? If you monster, big move, daily, bid, small gap lower for whatever reason, people are going to see that as value and probably end up bidding it. So we kind of go, okay, right, we'll position for the gap fill. How do we get in for that? This is a repeat from the last week's slide. Opening range breakout, prior candle break. I don't want to go over old ground here. Reversal candle, trend line break, high break. So again, back to the second slide. This flow chart. What's my gap? Common gap. I think it's going to be filled. Okay. Now, what do I think is the target? Well, I think it's just going to be filled. It's going to be just the prior day's close. Okay, great. So how am I going to get into it? I'm not just going to punt at the open. I'm going to wait. Okay, how am I going to get into it? Well, if an opening range breakout happens in the direction of the gap, I'm taking out with a stop above the high. Good. Okay, what about if I see a movement and it dips below the low? Okay, so you start to work out the flow chart. This is my gap. This is my filter. This is my trigger. Then you can relax. In the heat of the moment, you can relax. You can go, you know what? I've done the work. I've decided what I'm going to do. I've decided where the target's going to be. All I've got to do now is just watch, observe, and see how price responds, and see what happens with price, and see if my thesis is correct. And then when you get the trigger, you go, hey, that's where the stop's going to be. What's the size of my position to accommodate my predefined daily risk from my trading plan? Take the trade. Don't overthink it. Take the trade. All right, let's move on to adding to winners here. So this is kind of something that I think that it's there as an advanced technique, right? I really would be careful if you are kind of developing a strategy playbook, if you're kind of early on in your trading journey, ignore this. Jot it down by all means, but don't add the complexity. Your job as a trader who's trying to get the consistency is just to bat these singles, these doubles, just to put some numbers, just to see some growth in your equity curve, managing the risk, not getting too much downside. When that starts to become something that has a more longevity to it, and you've seen a decent period of time, then you go, okay, let me look at my trading and let me look at how I can maximize the most from my trading. And that's normally, there's a whole process for that. Don't need to go into it, but it's normally minimizing the losers, damage from the losers, and maximizing the winners. And then something when you're in this situation like a gap trading environment, you might want to add to the winners. So let's just talk about it briefly. But as I say, is that I'm not a huge fan of it if you haven't got everything else dialed in. If you have got everything else dialed in, then great. You've got to be looking to push the throttle down somewhere. You've got to be looking to make more from your winners. And the gap trade does that because generally speaking, the range is going to be wider, the move's going to be bigger. So you do have that chance and the momentum is there. It's a little bit more of a nicer environment than generally a kind of average day, if you like. So reasonable areas, we've got some chart examples of these. Your afternoon breakout trade, you dip back to a VWAP, support resistance with the moving average kisses. Examples are much better. Let's see. So Palantir, stock, US stock, gapped up huge. When it gaps up huge, but started to gap and rally. So we could say, and this is, by the way, I've got all of these strategies are just standalone strategies to use in other areas, but when you add them with the gap fill, they become a little bit more useful, right? And I always like to say, hey, an afternoon breakout trade, you look for the high that's put in before 5 and only take the trade after 5. That's UK time, by the way. That tends to give you a better chance of success, in my opinion. Listen, I've got, that's just my observation to it. You can go and have a look yourself, type of thing. So that'd be one way to add. So if you're in the trade already, you kind of go, okay, I'd add to it. I'm gonna look to add on that point there. First close, Palantir again. First close below a 5 period moving average, generally on a 5 minute chart. I like that. I think it's aggressive, but I like that when you've got the momentum on your side. First close below 20 as well, a little bit more passive, but that tends to give you a later entry. And if the trend is intact, it won't stay below there for long. It won't stay below there for long. Like classic range break fake, one of my favorite setups is when you get a range kind of formed, pushes below, can't really do much, pops straight back up into it. And this isn't a cherry-picked example, guys, because this isn't ripped off massively. It's done a little bit more. But I don't want to just cherry pick and the best example. I want to show you real world stuff that happens, last couple of weeks, real world, examples. So this fits it nicely in that you have a little break below, push the highs. And by the way, if you're on Trading Plan Pro, these are all in the templated areas, the afternoon breakout, the range break fake, the standard flag, your range breakout, your channel break and retest. All of those can be used in conjunction with your gap. And that's the thing, you bolt in these strategies into the broader reason why you're getting in. And maybe we'll do the whole webinar on this at some point, and building the playbook up and understanding the concept and reason behind why we get in the trade, supporting the thesis of the trade. That's the backdrop, that's the context, that's the higher time frame, that's the emotion behind it. And then getting into the actual trade, that's your setup, that's your strategy, that's your trigger. And when you bolt those together, that's when that's when things can really work for you. When you're just trying to do one thing without the other, I think, and then again, it's personal viewpoint, I think that's when things break and things don't work as well as they could. All right, let's get going. Screening for gaps. So if you want to screen for gaps, I think the first thing is to have a list of the main market. So if you're trading, currencies, you're trading indices, and you're here at the weekend, you're coming and looking at the weekend gap, just have a look and eyeball those. You can scan through those yourself. You don't need to have any specific tool for it. However, if you want to trade indices, you want to kind of scan for stocks, then TradingView's got a great gap screening tool. And here's a way to use it. So I'm going to show you some of the settings, and we'll run through this reasonably quick. Go onto Screener, go into Extended Hours, and adjust the filters. And we want basically a market cap between 300 million and 2 trillion. I think it's plus over 2 trillion. Gap above 2%, gap below minus 2%. And this is what it looks like. Here, symbol type, all of the common stock, all the US exchanges, the main ones, 300 million to over 2 trillion, gap percentage above 2%, and then you do gap percentage below 2%. So that's going to give you all the gappers on the day that are above 2% and all the gappers that are below minus 2%. So decent down gaps, decent up gaps. You don't want small gaps, really. You might do, maybe you do, right? Depends on the strategy you're kind of deploying. But just giving you an example. And here we can kind of start to see the ones that have gaps, right? Some pre-market gap, and they'll come in, and now you can start to screen, or should I say, sort these into pre-market volume. I like to put the highest market volumes here first, because the higher volume tends to be more significant. It tends to be more significant. It means that there's likely to have a decent move after the opening bell, and that's what you want, right? That's what we want as day traders. Make sure you've got manual refresh checked. That's just so annoying when it refreshes every 10 seconds. It just you kind of trying to screen for stuff and it's refreshing because something else happens. Put on manual refresh and refresh it, manually with the click of a button. So now you want to build your kind of watch list. And what I like to do here is select all of the gaps that I think are got a reasonable volume. And again, up to you this, but sometimes you're not going to get many. Sometimes you're going to get a fair few. And sometimes you might get instruments that aren't available on the broker you trade with. That's fine. You might not get every day, but you don't need to get every day. This is something that you can kind of have in your playbook and monitor. Select all those, and then you can add those to selected to the watch list and create a watch list now of all your gap up, gappers up, and gappers down in one list. And then you can keep scanning through those. So you do that, and then this is what you get. And it's the other day, I kind of did this and just show you the workflow that I've got. And you put these in a watch list, and now you can scan through pretty easily and just do your technical analysis on those, and just look and do some research. And don't be lazy about it. It's too easy to get lazy and go, oh, it's a big gapper. Just dig in very quickly. Just see why it's gapped. You don't have to be an expert at fundamentals, but just understanding why something's moved, I think, is important. Okay, let me get to this tool that I have for you. So. And again, I'm happy to share this stuff. I work with a developer, to build this. So we go back and forth and we try and get something that I think is doing what I need it to do. And then I'm like, hey, you know what? I'll share it with you guys. I'll share it with people who, are interested in using the tool. No charge for this. It's charged for me, there's no charge for you. Helps to test different gap fill ideas. And what we kind of do here is, I think I've got another slide on this. Oh yes, a bit of a warning. So this is the first version. I like to update these over time. I like to test them and see if they got some mileage to them. I'll update them and I kind of post the update. So you get an update if it comes out. And like all these things, I'm not a data scientist, right? I just like to have some support for my thesis and my observations, if you like. So don't rely on it. There's a little bug with this. It's not a massive bug, actually. It's perfectly fine to use. But there's some kind of phantom trades. You'll see it when you use it. It sometimes opens and closes a trade due to the way that TradingView doesn't let you. The developer basically said, God knows what it actually means. But he wanted to make it so that it was as accurate as possible, and to do that and to not get something that was sort of behind the curve, if you like, and putting stuff in and not making sense on a proper fill you have every now and then you get kind of something opens and closes. It doesn't really affect it much, and it gives us a good approximation, but it's worth kind of pointing out with that. And again, first version, this will be improved over time. Let's go to tradersmastermind.com/gap, email address in there, and then go straight to it. Let me show you how to use it. And by the way, thank you. Those of you who downloaded the opening range breakout engine, which is one of the really, really, really powerful tools to try different versions of the opening range breakout. Give me some good feedback on stuff you guys have tried it on that I've not tried on, different parameters. So that's this is really, we're crowdsourcing things and ways to use this sort of stuff. So you've got some parameters you can change. You can change. I want to do long only. I want to do both. I want to do short only. And you can choose to put the data table on the screen or not. Have I put it there? So there's a little data table. I've got some better screenshots in a moment. I would recommend leaving that on. All right, leave that on. Here's your gap parameters. So we toyed around with this, and actually what I wanted was to be able to choose to take a gap. And by the way, while I explain this, if it gaps up, it goes short. If the price gaps lower, it goes long. We're testing for the gap fill, the propensity for the market to gap fill under different conditions. We can add stop parameters, we can add target parameters, we can add gap parameters, and we're really testing that. So the idea is you go back and go, hey, I want to look on the NASDAQ. If I'd taken this type of gap under this condition, what will the results be? That's really kind of what it's there for. So minimum gap type, maximum gap type. You can change that in pips or percentage. So good parameter to test would be something like, hey, I want to take both trades, a bit of a tongue twister, have the table up there. I want to take gaps that are larger than 0.5%, you can put that in, but not over 1.5%, say. I don't want to take a gap fill if it's too much. I want to take it in a sweet spot. And you can play around with this. So it will go short if it gaps up. It will go short if it gaps up over 1.5%, but not over 1.5%. And then it will go long, it gaps down below 0.5, minus 0.5%, but not under minus 1.5%. Hope that makes sense. Okay, so exit criteria. Now, there's a couple of things here. There's a standard sort of gap fill you want is to say, okay, listen, gap size percentage, I want to take 100% of the gap. That's a pure gap fill trade, right? 100% of the gap. If the gap is 20 cents, it will take 20 cents target. If the gap is $20, it will take $20. So that's the pure gap fill trade. But you can adjust that as well. You can have half the gap. What's the chances of it? What's the chance of what's historically happened? Has it filled the gap half the time? Has it, not how it filled the gap. Has it filled half of the gap? You can play around with this. There's an exit here that always exit at the end of day 1 or day 2 or day 3. You can choose that. I wanted to put this in because I don't want to be in a trade, and I wouldn't be in a trade if I trade in a gap after, unless it went in my way. Well, if it's gap fill, no, I would want to be out with it. Either did or it didn't. Different if you're trading kind of breakaway gap, where you might be looking for a 1 to 3 day move. We talked about that last week. So I definitely want to exit this at the end of the day if the gap doesn't fill. And don't want to stop parameter. You can have no stop if you just want to test how gaps fill or not, and just get a reasonable broad kind of a percentage on that based on history. Or do I want to kind of have a stop in there and say, listen, if the gap is 50 cents, I want a 50-cent stop. And you can do it in pips or you can do it in percentage. So a good easy way of doing it is to say, right, I want to take a gap. If it fills, I want to use a stop at the same size as the gap, and I want to take gaps in between this size, go away and show me kind of what you've done. And that's pretty much it, I think. So I also recommend, because of these weird little phantom trades that don't make much impact to it because some of them are very, very small, some of the right, some of the wrong. Just turn off trades on chart. That shows you the trades that actually the strategy would have deployed. And this is what it looks like, right? You can come up and say, okay, it gaps up, it goes short, exits on the gap fill, gaps up, doesn't quite fill, exits at the end of the day, gaps lower, fills there. You can see how that works, right? And you can see the strategy performance here, profit based on your kind of underlying base capital, total trades it took, win rate, profit factor. Again, first version, this is a free first version for you guys. Play around with it, see what you think, give me some feedback. Don't rely on it, please. You know, this has not been soak tested, and I will not be deploying $4 million of my capital into this tool, but I will be using it to kind of get an idea and just get a feel and just play around and say, okay, the bigger gaps have a propensity to fill or not. These are the sort of questions you should ask, and then go and look at the logic behind it. All right, so the summary. I know we've run through really quickly this week, you know, because there's so much stuff in there, and there's so many different avenues we could have gone down. But you know, I wanted to cap this off with giving you as much information as possible. You take what you want, and I think what you'll do is you'll go, hey, you know what, rubbish. I like that. Let me learn more about that. And maybe you go away and dig into stuff, and maybe you'll add it to your playbook. Maybe you won't. But you know, that's the really objective of these webinars, to give you as much tactical information as possible. And then you go, yeah, you know what, I want to find out more about it, and that could help me. So remember your gap types, categorize a gap type using the data you have and the context you have. Note down your plan of action, so important. Understand your context, wait for your trigger, stick to your plan. It's a simple process, but we overcomplicate it, don't we? We overcomplicate it as traders. We overthink things, we overtrade things, everything's over. But just say, you know what, there's like a good gap. Fill potential. It's reasonable. It's not huge. It's not a great reprice. Fundamental reason for the gap. Daily's on my side. You know what? If we break that opening range of 15 minutes, I'm going to take the gap. Use the stop of this. It makes it easy for you. You don't have to overthink things. All right. tradertomastermind.com/gap if you want that tool. Give me some feedback on that. And that's pretty much it. Any questions, guys, ladies and gents? Let me have a look. Ski. What was I going to leave this on? You know, I'll leave on the URL for you. Well, it's not hard URL, is it? What have we got? Mark Pooley's here. Good to see you, pal. Rowie is here. Rowie has some of you gentlemen actually who have been on the webinar a few times, have signed up for Traders Mastermind, and I'm pleased to see you. And maybe we'll see you on the members call tomorrow, where we kind of do the group coaching thing. It'd be great to see you guys in person. Rowie's put, hey Mark, first thing I want to let you know that Traders Mastermind is great, really valuable. I'm happy to join. I'm glad. There is loads of stuff on there. I know there is. Just DM me if you want some context and where to dig and trying to help you out personally. Right, trading the gap of momentum at the open is a thing I'm good at. When it happens, okay, good, and I like it. The problem is, as you know, it doesn't happen every time. It's true. Less on indices, yes, than in specific stocks. Since I only trade the Dow, I find myself forcing momentum trades at the open when it isn't clear, because I'm feeling like most days I just won't have gaps opportunity. So I convince myself to take momentum even when it's inside yesterday's range, etc., because I want to gain experience. I'd like to get your opinion. I tried to get more assets on the screen, NQ, which is NASDAQ, CL crude oil, at the same time, but it's confusing me. Or maybe I should trade DAX as well. Okay, answer to that, Rowie, is you're quite right that, you know, the indices aren't going to gap massively a lot of the time. And at the moment we had a bit of a flurry where NASDAQ's gapped higher, and that's great. And that's one of the reasons why I wanted to cover this topic, because we are gapping at the moment. But you are in this situation where you go, okay, and you eloquently put this in the, hey, I want to gain experience, I want to trade, but I'm not quite getting my parameters met. So what do? You've got to be strict with yourself. You've got to be strict, Robbie. You've got to say, hey, listen, that's a momentum trade, and I'm only going to trade it on these small amount of instruments. I don't want to spread myself too thin by watching loads of stuff. I think you're fine. I wouldn't add any more stuff. Just focus on what you're doing. But what you could do is say, hey, are the parameters met for my momentum strategy? Yes or no? If they are, trade it. If they're not, stop and go, okay, what do? I either start to build mean reversion range bound trades, or this is my favorite, say, you know what, I'm not trading today. And you might be like, oh, Mark, come on. Bear with me. If you say that, what you can then do is start to do some other work in your trading business, i.e., I'm going to research some other momentum plays. I'm going to build another strategy playbook. I'm going to look over my journals. I'm going to do something else that's not clicky trading to improve my trading business. And that will help you way more at the moment than trying to spread yourself too thin and watch noisy markets. It sounds like, oh, they're really, but I honestly, if you go and you start to do this extracurricular homework, as it were, well, that will improve your trading. That will improve your trading way more, and you'll build more strategies. You'll build more ways to take advantage of mean reversion trades and quiet days potentially. And so, that would be my kind of recommendation for this, rather than spreading yourself too thin. Let me just go to the next question here. Question 2. Yeah, I think we've got time. Rowie, appreciate you respecting the time. You say we can get clues from the overnight session about the filled or filled fake. What do you mean? Okay. So the overnight session is, if let's say you're trading index, right? You're trading the NASDAQ, it's gapping up. If on the overnight session has been a real solid trend day, trend overnight, i.e. the European session in the morning has been rallying, NASDAQ's gapping up and it's opening near its overnight session highs, you might say, ooh, but I need to be careful because there's still momentum. There's still that demand coming in, versus an overnight session that an overnight session, I mean, from the US close to the US open. So we know if we're trading an indice or an index, should I say, you kind of get the movement in the futures, but actually the cash session is that close to open. If that's really, really rallied but pulled back massively, maybe the gap is still up, but actually it's pulled back off overnight session highs, and that might be like, okay, maybe it's exhausted. Maybe we're starting to see some sellers coming in. Mark Paul, you said, I really like that, could have done with that over the last 2 weeks. Okay, perhaps that's to do with sitting on your hands. And yeah, Mark, that's one of the things. We all want to trade, don't we? We have the urge to trade. We're traders, right? We love to trade. We love the markets. Why we're involved in it. That's why we spend so much time, resources, just because we want to trade. And so it's very, very tough for us to sit down in front of the screen and not trade. But actually, that's the correct thing to do when things aren't lining up. The wrong thing to do is to sit in front of the screen and go, what's the best thing in front of me today? Now, that's a very, very distinct, different question to, this is the strategy I trade. Is it showing me that strategy today? Because if we ask the first question, what's the best trade that I can take today? Today might be a rubbish day. It might be nothing going on. It might be choppy. It might be this. And you're trying to find the best thing, which might be absolutely useless compared to maybe conditions you've had a couple of days ago that were like much more in tune with the market you want to trade. And so being strict with that, rather than looking at each day and going, what's the best today? Going, hey, this is what I trade. Does today allow me to express that idea? No. Okay, let me go and do something else. And because I know I'm just going to dig myself a big hole, I know I'm going to damage my equity curve. There's no point. I don't want to damage my equity curve. I want to grow my equity curve. And one of the things with trading, as we know, and not to go kind of off into rabbit holes here, but is to protect what we've made. I think many traders, I think you'll find this as well, is that making the good trades isn't so tough after you've kind of got some experience in or what have you, but giving it back is where the issue lies. And one of the seeds of that is to be getting involved with conditions that just aren't right, and being brave enough, and brave is a bit of a big word, but being able to say, you know what, hey man, I risk my capital when I want to, and my job is to extract money from the market when I can and manage my risk and try and do this. So why would I get involved when really the market doesn't seem to have much edge, and there's not really much, I don't think there's much opportunity. And actually, I know that from history, I'm not very good in these markets. So why would I give back all the stuff that I've made in the conditions that just aren't right? Sit tight, don't do anything, trade very, very light if you must, but I really don't even suggest that. I say just go and do some extracurricular stuff to work on your trading as a whole. And that is going through your old journals. That is going back and asking questions about, even using the tool like this and going, okay, well, I'm interested in gap. Let me go and study that. Let me spend a couple of hours in this day doing that. And I'll spend an hour looking at my journal, and then I'll come up with something, and that's productive. And you feel like you've done something productive at the end of the trading day, but you haven't got caught in the chop. And another thing you can do, both of you guys and anyone else, is to sort of please that inner voice that goes, should be trading, should be trading, should be trading, should be trading, call yourself a trader, you should be trading. We all have that. Is to set some alerts. So get your chart, your 15-minute, your 5, whatever you trade from, and set alerts and say, okay, this is not, I'm not interested in this market right now. However, if we get to that level or that level, that's an area I'll consider doing some business in. And when you do that, it sort of pleases that little voice that's going, should trade, should trade, should trade. You say, okay, I will look at the market if we get to these levels. And then you can kind of almost compartmentalize that in your brain and go, hey, I'm ready to trade if the parameters are met. Let me work on this. And it's almost like you have to sort of trick your mind in a way to doing the things that are going to serve you medium term and long term rather than short term. I've really gone on a rant there, but yeah, we can talk more about that. Both you guys are members, so on Thursday perhaps. Jacob says, great content as always. Thank you very much. Appreciate that, Jacob. What's your opinion on moving stop loss in profit? Valuable concept or just fear of losing? Ooh. Big topic, Jacob. I think it depends on where you are in the move, right? I like to think of a trade as, you've got the takeoff, the cruise, and the landing. Sort of aircraft terminology. I did my private pilot's license ages ago, and stuff sort of came to my mind. You're most vulnerable in the takeoff. So when you're taking the trade, are you just getting away from your trade entry, just starting to, maybe you're taking a double bottom, say, bought the double bottom. As it's starting to come up and maybe break resistance and start to trend a little bit, that's the cruise. But as it's in that little double bottom area, that's the takeoff. That's when you're vulnerable. That's when your stop is kind of got to be there to manage your risks. It might fail. As it starts to go your way, if you're target based and you're flying a plane, you're saying, I'm going to that destination, you start to look at how price is behaving as it's approaching that. And that's when you kind of come into the kind of landing concept. But to answer your question, Jacob, I think you have to be stubborn to a certain extent, i.e., I'm not closing this trade unless it hits my target or it hits my stop. But also being mindful that your targets may be a little bit too big for the current conditions. And that's when people get caught out because they go, oh, I want this 200 pip target. They don't get it. So should I move my stop? It might be a target issue, i.e., are you looking for an A to B trade or are you looking for a kind of range extension trend type trade? And so I think that there's not a broad answer for all of this. It depends on what you're trying to achieve, but generally speaking, and this is a big generalization, does depend on conditions, depend on strategy, I'd avoid moving that stop. I really would avoid it. I say that, however, Peter, who does a Tuesday call, he always moves his stop to break even, and he will take 0, 0, 0, 0, bang, massive winner. So there's a lot of personal approach in it and how you feel about conditions and how you feel about your own trading. But I like to kind of, be strict with my stop, leave it there until the trade gets in the safety zone, if I own the cruise. And so it's like a trending environment. I've got a double bottom, I've got some cushion, and I can put my stop still a reasonable distance away. But moving it too early, I think, is a mistake. As Dean said, this one really clicked. Appreciate that, buddy. Awesome webinar on Tool. Thanks for sharing, Linda. Linda said, do I do one-to-one coaching? Not really, Linda, I'm afraid. There's a couple of traders I work with who I've been working with for years and years, and I don't really have space. But if you kind of want to come on Traders Mastermind, then feel free. I don't want to plug this at all. This is about gap trading, about the content here. But we have a reasonably small group of traders who jump on the calls, and we will talk about trading and how to improve and all that type of stuff. That might be something that's valuable to you, Linda. Thank you for the question. Sindri's put, can I try a funded challenge if I'm doing okay with a 100% account, $100 account? $100 account? Yeah, why not? Why not try it? What have you got to lose? I don't know how much the funded things are. It could be something to consider. Have you tested, Peter Daniel? Peter's on the call. Have you tested on currencies and most gaps filled in a day or two, and there are not many gaps on currencies? Yeah, you're right, Peter. I've not explored them, but I think you're right. You're the FX expert. But I think they generally do, right? Because it's a pair, you're trading one currency against another, and they take a few days to fill. But like you say, you don't get them so much. You don't get them so much. What if you trade SPY gaps? If so, any tips? Yeah, Linda, I do. I think the SPY or SPX, as you put it, gaps are there. I like the. It's just, I think there's a subtle distinction. We really didn't have time to go into depth that I wanted with this, but there is a distinction between the index gaps and the equity gaps, because generally the index obviously is a basket of stocks, right? So it's moving in unison, and there's a kind of, it's more of a feel and a general underlying sentiment behind it. So, you know, that's why I like those, because if they're not too big and you're against the trend, I like to trade the gap fill. I think that's good. But if you're kind of with the trend, then trading the gap fill fake is slightly better. I wanted to include it, like, you know, the other day with that NASDAQ gapping up, tech was just going mad. Tech was going crazy with the AI thing and Nvidia and all that stuff, gapping up. The chance of that filling was probably slim today. Oh, sorry, when I mean, don't mean today. Today, I mean the gap fill day, because there was so much pent up buying and aggression and blah, blah. So the gap fill fake was better. But then later on, which is another strategy, 3 or 4 days down the line, maybe you do want a position for it. So maybe it does ultimately fill. So any tips for that is just to be mindful of the size of the gap and and go back to that concept, I think, of the day, looking at the daily chart. Honestly, just understand that daily chart and how that plays into what you're trying to do is so key. I think it's ignored by many traders. It's such a simple thing to do. Just use that as a filter. Thank you, Robert. It's a bit more of a question here. Thanks, Mark. Super useful. Could be something to work with the DAX and NASDAQ. Yes, absolutely. DAX can be a real gappy little animal. Treasury Mastermind has been so useful for me, and I recommend it to anyone here who's not signed up. Thank you, Robert. Anyway, on Shetland for the next 10 days, so we'll miss the next couple of calls. Well, enjoy yourself, Robert. Rowie has put great, makes sense about the overnight session. Thank you. Work on it. A question about your answer and what happens if momentum starts to happen without a gap, and I already decide not to touch, as you said, like all the theme change. Yes, Rowie, good question. Otherwise, you see momentum, you want to take it. I would rather you miss more stuff than take stuff and regret it. So there's a pendulum, like you're over trading at the moment, go to under trading, miss stuff and be comfortable with it. So, you know what? I don't think that momentum's going to continue, and don't take it. And if it does, go, hey, you know what? Let me note it down, screenshot it, put it in the document, put it in your document, whatever, however you journal. I think that's a better way of approaching it rather than to get it perfect first time. If you're trading too much and you feel like you're jumping on momentum too much at the moment, you're getting caught out, really take it the other way and go, actually, you know what? Let me undertrade. Let me miss a lot of stuff. Let me only take stuff that's matching my criteria and have some criteria for that. And then at some point, the trader you'll be months down the line will be someone who gets it, not perfect, but in the middle, where you'll take the right amount of trades. You always take few. You want to be kind of oscillating between now under trading and over trading a little bit. You're always going to be adjusting that dial. But if you're over trading loads now, drag it right way back to under trading and miss stuff. That should be your goal. See you tomorrow, Ree. Thank you very much. Okay, run through here. We've got Mark says, mine is always after a bank holiday. It's not going to trade a few days on the side, then broke it today to short Tesla. You know what? I did a daily email, Mark, where I talked about the trader's nemesis and Monday being a trader's nemesis. And quite often I see traders who, you know, they really struggle after a few days off, whether it's eagerness to get in, whether it's calibrating to current conditions, I don't know. So yeah, be mindful of that. Richard says, thank you for the presentation. Mark says, moving the stops on a big thing, not giving the trade room to move. Yeah, it's a challenging thing. We'll dig into that perhaps at some point. Jacob, appreciate your answer. Thank you. A few more questions. We've got thanks from Shrindi. We've got Linda says, what conditions would you trade a gap fill right at the open? I don't think any. That's controversial. I know, yeah, and you've said some gaps are small and fill fairly quickly. Are they high risk? That's a personal thing for me, Linda. I feel like I get caught out. I know I get caught out when let me qualify that. If it's a really, really good structured daily, and for whatever reason I just got that, you know, something fits on the higher time frames, everything fits, I might do it. But I'm very, very rarely. I want to see the trade, how the trade responds, because we've got all the clues. The biggest clue is how people respond to the gap, right? How it responds to the open. Does that mean I'm going to miss stuff? Yeah, because like you say, sometimes it's gap fill, trade's gone, and that's fine. But you know, very often, as we see, price can just rip off, and then come back and fill, because there's so much kind of volatility and chop and order flow going on the open. It's very difficult to not to know, but it's a lot more randomness and noise, right? It could be someone just comes in, buys 400,000 shares really, very quickly, sends the price skyrocketing, comes straight back to the opening print, and then starts to fill the gap properly, and that would have stopped you out. So, you know, I think that the open is, especially nowadays with a lot more algos and type of stuff, it depends on the trade, right? There are some times when, and let me give you an example of one which I quite like, is a sell the news trade. So we had the other day, right? We had the debt ceiling deal done, blah, blah, blah. Everyone knows about that. We kind of gapped up a little bit on DAX. We gapped up on them, and it was bank holiday, wasn't it? So we gapped up, that's it. But then we filled that pretty quick, or we kind of came off pretty quick. That might be a time when you go, hey, a sell the news gap. So you've seen momentum, you've seen it, it feels like an exhaustion gap. That might be when you trade it right at the open. Just because the underlying backdrop and context and feel behind it is one of, okay, I feel like it's run out of puff, but you'd probably got to have a wider stop with that because you just don't know where it's going to go. Thank you very much. Thank you very much. Thank you very much, ladies and gents. Okay. I think I'll call it a day there. Thank you very much for your attention. I hope you find that valuable. We're going to do some interesting topics as well coming up next month. And yeah, hope you enjoyed it. Take care, guys. See you later. Keep your risk managed. Bye-bye.